Where's the link? I sent it. I can send it again.
To file current reports upon execution of advisor-led secondary transactions,
Stay on.
general partner or limited partner clawbacks, removal of a fund's general partner, termination of a fund's investment period, or termination of a fund. The proposal would require advisors to file a current report within 1 business day of the occurrence of one or more of these reporting events. The proposed changes are designed to allow the Commission and s.e.c. to receive more timely information about certain events that may signal distress at qualifying hedge funds and private equity funds, or identify patterns that may indicate market instability. Second, the proposed amendments would reduce the threshold for reporting as a large private equity advisor from $2 billion to $1.5 billion in private equity funds assets under management. Lowering the threshold would result in reporting on Form PF that continues to provide robust data on a sizable portion of the private equity industry. Additionally, the proposal would amend Section 4 of Form PF for large private equity advisors to gather more detailed information regarding fund strategies, use of leverage and portfolio company financings, controlled portfolio companies and their borrowings, fund investments in different levels of a single portfolio company's capital structure, and portfolio company restructurings or recapitalizations. The proposed amendments are designed to provide useful empirical data to s.e.c. to help better assess the extent to which private equity funds or their advisors may pose systemic risk, and to better inform the Commission's regulatory program to enhance our ability to protect investors. Finally, the proposed amendments would require large liquidity fund advisors to report substantially the same information that money market funds would report on the recently proposed amendments to Form N-MFP. Together, Form N-MFP and Form PF are designed to provide a complete picture of the short-term financing markets in which money market funds and liquidity funds both invest. The proposed amendments to Form PF would enhance the Commission and s.e.c.'s ability to assess short-term financing markets and facilitate our oversight of those markets and their participants. Thank you for considering our recommendation.
Muted. Thank you so much, Sarah and Michael. Now we'll turn it over to Jessica Wachter, our Chief Economist, Head of the Division of Economic Research and Analysis.
Thank you, Chair Gensler. Today, the Commission is proposing amendments to Form PF. Private funds account for $11 trillion under management, making them an important means to connect investors with capital markets. Form PF currently requires annual reporting, increasing to a quarterly frequency for certain private fund advisors when assets under management pass a size threshold. Form PF provides the Commission and s.e.c. with an important window into the basic operations and strategies of private funds. Private funds employ a wide variety of strategies, some of which may be complex and some of which use leverage, either explicit or implicit. With sufficient leverage, the risks in these funds could lead to sell-offs in asset classes, sometimes called fire sales, harming investors both in the fund and more broadly. The revised rules would require prompt reporting based on significant events, such as losses exceeding 20% in a short period, a large increase in margin requirements, or a default of a significant counterparty. This gives more information than existing reporting requirements, which provide a limited snapshot at a point in time and are filed months after quarter or year end. This real-time information would provide the Commission and s.e.c. with some early warnings of significant events in financial markets that could indicate broader systemic implications or investor protection concerns and facilitate potential regulatory responses. Results could be more resilient financial markets and stronger investor confidence. The rules also expand regular annual and quarterly reporting requirements of Form PF for advisors for private equity funds and large liquidity funds, respectively. This new information would help in the monitoring of systemic risk and would help the Commission better protect investors by providing new insights into the diversity of trends and investment strategies used by those private funds. While this additional reporting would lead to costs to some funds, some of which would be passed on to investors, we believe these costs would be limited due to the targeted nature of the amendments. In closing, I thank our colleagues from the Division of Investment Management, the Division of Enforcement, the Division of Examinations, and the Office of the General Counsel for their collaboration. And I thank you all for your attention.
Thank you, Jessica. Now I'll turn to my fellow commissioners for their comments, questions. Commissioner Peirce.
Thank you, Mr. Chair, and thanks to Mike, Jessica, and Sarah. And Sarah, thanks for stepping back in after so ably leading the division last year. We very much appreciate that, and I appreciate you standing in for William, who's on jury duty. I, of course, want to begin by thanking the staff of the Divisions of Investment Management and Economic and Risk Analysis and the Office of Chief Accountant and General Counsel as well. Although I'm unable to support today's proposal, I do appreciate all the hard work and effort the staff put into the proposal, including fielding numerous comments and questions from me. My objections to the proposed changes, however, are fundamental. As we described at the time of its adoption in 2011, Form PF, quote, is primarily intended to assist the Financial Stability Oversight Council in its monitoring obligations under the Dodd-Frank Act. As the Commission made clear in the release accompanying Form PF's finalization, the Commission's use of Form PF information in conducting its regulatory program is ancillary to the underlying purpose of facilitating s.e.c. monitoring for systemic risk. Congress did not conceive of Form PF to facilitate the Commission's desire to inoculate well-heeled investors against downturns, losses, or fund failures. Today's proposal disregards these facts and represents a fundamental shift in Form PF's scope and purpose. Although the release cites monitoring and, where possible, mitigating or forestalling market-wide disruptions as rationales for the proposed changes in reporting, the release provides scant evidence that the amendments to Form PF would enhance s.e.c.'s ability to monitor for systemic risk. Rather, the enhanced reporting seems intended primarily to provide the Commission with additional information to support its regulatory and enforcement programs. A regulator's desire for data is insatiable, but more data isn't always better. Before we seek additional information through Form PF, we must show what we have done with the information we already require and show that it's insufficient to allow s.e.c. to monitor for systemic risk. I don't think we've done that. Merely citing gaps in data isn't enough. There will always be gaps, or at least I hope there will always be gaps, in just what information the government can access on private activities, but we must ask, is our desire to fill these gaps born of necessity or of curiosity? I judge it to be the latter. If finalized, large hedge fund advisors and all advisors to private equity funds would have one business day to report to the Commission the particulars surrounding key events. These reportable events include, as you heard, extraordinary investment losses, significant margin and default events, and large withdrawals and redemptions for large hedge fund advisors, and in the case of private fund advisors, the execution of an advisor-led secondary transaction, implementation of general or limited partner clawbacks, and the removal of a fund's general partner. Requiring almost immediate reporting of localized events would distend Form PF into a tool for government to micromanage private fund risk management. A hedge fund suffering losses equal to or greater than 20% of its net asset value over the course of 10 days is unquestionably significant for that hedge fund and its investors. But why is it appropriate or even wise for the Commission to insist on being notified of this within one business day? Surely the fund advisor will have its hands full in such a fraught period and will have little time to spare to fill out government forms. What makes this information so critical to us at the Commission, let alone s.e.c.? If the losses are localized to a single fund or even a handful of funds, why involve either government entity on a real-time basis? Form PF's purpose is to facilitate s.e.c.'s monitoring of system-wide stability, not to inform the Commission about isolated trigger events affecting individual private funds. Sure, isolated events can be indicative of systemic or potentially broader downstream disruptions, but what is the limiting principle here? Merely asserting that isolated particular events could potentially indicate system-wide vulnerabilities without any hard data-driven analysis seems inadequate to justify the enhanced reporting. Will s.e.c. and the Commission really be blind to system-wide threats absent these real-time reports of one-off events? Whether it's 20% losses or general or limited partner clawbacks, what does the record tell us concerning the correlative links between certain noteworthy events at one or a handful of funds and the wider market? We owe the public a clearer understanding of the objective or subjective calculus or metric we have in mind when we say that contemporaneous reports from advisors concerning one or a handful of key events are significant enough to justify this additional reporting burden for hundreds of advisors. Saying that an otherwise isolated problem in a hedge fund could be indicative of a more global concern just isn't enough. As you heard, we're also proposing to change the reporting threshold for large private equity advisors. But rather than raise a threshold that is now more than a decade old, we're proposing to reduce it from the current $2 billion to $1.5 billion. The reasoning behind this proposed reduction is unsatisfying and potentially harmful. When the current threshold was established, approximately 75% of the private equity market based on committed capital was covered. In the intervening years, the private equity market has grown such that with the increased number of smaller private equity fund advisors operating below the $2 billion threshold, only 67% of that market is represented. By this logic, if the industry continues to grow, we have set the precedent that we will continue to reduce the threshold again and again as the addition of smaller advisors means that a smaller percentage of advisors meet the reporting threshold. What is so magical about 75% of the industry falling within the ambit of Form PF? Was the current $2 billion threshold chosen to reach 75%, or was 75% nothing more than the result of the $2 billion threshold? Moreover, reducing the threshold seems to fly in the face of the Commission's thinking in 2011 when we said that these thresholds are designed so that the group of large private fund advisors filing the form will be relatively small in number, but represent a substantial portion of the assets of their respective industries. By anyone's definition, a form that continues to gather data on the activities of 67% of the private equity industry is substantial. So what has changed? Why are we no longer concerned about cost to smaller private fund advisors? And relatedly, are we in danger of putting the brakes on an otherwise dynamic and competitive industry? Changing the threshold is a good idea, but I urge my fellow commissioners to put their support behind increasing it, not reducing it. I look forward to hearing from commenters as they evaluate the merits of this proposal, and certainly look forward to thinking in light of their comments about the value of this additional reporting. And I thank you in advance for your insights and wisdom. They will certainly inform my determination. And again, thanks go to the agency staff who worked so hard on this proposal.
Thanks, Commissioner Peirce. Commissioner Lee?
Thank you. Today's proposed amendments to Form PF contain key enhancements to investor protection for private fund investors, but also importantly, better tools for monitoring systemic risk. The private fund space continues to grow with the latest aggregated data from Form PF showing over 3,300 reporting fund advisors, overseeing or managing over 37,000 funds, and with aggregate net asset value of $11.7 trillion now, which is more than double the amount from just 7 years ago. Form PF provides critical data to assist the Commission in understanding both at the firm and industry-wide levels significant information about this vast and growing market, such as overall size, investment concentration, leverage, liquidity, and counterparty exposures. And importantly, this data also serves to inform the work of the Financial Stability Oversight Council in monitoring for activities that may pose systemic risk to financial markets. Today's proposed current reporting requirements in particular would further that goal by requiring certain advisors to timely report significant events such as deep losses, counterparty defaults, or the inability to meet margin calls. And these kinds of events raise not only investor protection concerns, but in some cases may also implicate systemic risks of the type that s.e.c. was designed to address. And Form PF data has also informed policymaking and delivered much-needed transparency in this area to the public. However, while we have worked to bolster our oversight program since the first filing requirements over a decade ago, we now know more tools may be needed to effectively examine and monitor the private fund space. Today's proposal would provide critical tools to help the Commission and s.e.c., including its now reconvened hedge fund working group, in making timely determinations as to whether certain events could pose systemic risks. and monitoring for systemic risk is a key pillar of s.e.c's mission. It's important for us to support that mandate. I hope the recent reinvigoration of the s.e.c will continue apace so that financial regulators can work together within our complex financial ecosystem to maintain a focus on our financial stability for investors and for the broader American economy. And given the growth and complexity of private funds, ensuring that we have the data we need in this space is an important component of that work. So I'm happy to support today's proposal. I'd like to thank the staff in the Division of Investment Management for their pragmatic and forward-looking approach to today's recommendations. I also want to thank staff in the Division of Economic and Risk Analysis and the General Counsel's Office for your hard work. So thank you.
Thank you, Commissioner Lee. Commissioner Crenshaw.
Thank you, Chair Gensler, and thank you to my colleagues. Last year, I gave a speech about assessing the unknown. My thesis was that we should proactively try to anticipate the risks that may arise and proliferate in our financial markets. If we continuously evaluate the threats that our markets and investors may face, it should help us promote market resilience and appropriate investor protections, even when destabilizing events inevitably occur. That process is critical, but it has to begin with reviewing and analyzing accurate and sufficient data. With regard to the private funds market, the Commission historically has had little data about the economic activities of private funds and any risks they may present to both investors and the larger financial system. Consequently, as part of the Dodd-Frank Act reforms, the Commission adopted Form PF. It was a good step forward, providing both the Commission and the Financial Stability Oversight Council, as you've heard a lot about today, FSOC, with data about private funds to help assess risks. And while Form PF information has been helpful to our understanding of private funds, the past 10 years also have highlighted shortcomings and gaps in the data. These gaps in visibility are compounded by the simultaneous growth in the size of the private funds market and these funds' increasingly complex structures, strategies, and exposures. The Commission must keep pace with the market evolution, and Form PF updates are fundamental to providing the Commission with high quality and meaningful disclosures. This includes requiring more granular and timely disclosures and updates that will improve our understanding of the private fund industry and the potential risks within it. Accordingly, today's rule proposes to amend Form PF in a variety of ways. I'll briefly address 3 of those important changes. First, the proposal would require advisors to certain large funds to notify the Commission when there are signs of stress at those funds that could result in acute risks to investors in the markets. The more timely updates should advance the Commission's oversight role. It's much harder to effectively plan for or mitigate risks when the information we're getting is already stale. Second, the proposal requires more detailed information from some of the biggest advisors to liquidity funds. These new data are essential to understanding these funds' characteristics, including their susceptibility to runs. Finally, the proposal would require more specific disclosures from all advisors to private equity funds. The private equity fund market in particular has grown dramatically in the last decade, and private equity advisors have expanded the scope of their investment strategies and the types of their offerings, including a significant increase in credit strategies. In other words, they could be investing more heavily in risky debt, such as collateralized loan obligations. This proposal is an important step that seeks to put the Commission in a better position to understand, assess, and take action regarding significant developments at private funds, potential stresses to the broader financial markets, and practices that raise potential significant investor protection concerns. Thank you to the Chair's Office, the staff of the Division of Investment Management, the Office of the General Counsel, and the Division of Economic and Risk Analysis for their thoughtful work on today's proposal. I look forward to reviewing the comments and working with the staff as we continue to move toward a final rule. Thank you.
Thank you, Commissioner Crenshaw. Thank you, all of my fellow commissioners. I will say before I move on, I miss Commissioner Roisman. For the public, Friday was his last day last week, so we're now 4 commissioners strong, but we all benefited from Alad's work, his dedication to public service, his advice and counsel. and I wish him well in whatever his new journey is and adventures. Today, the Commission is considering amendments to Form PF, Private Fund, a form that came out of the financial crisis in 2008, but just a little bit of background too. We had issues and challenges in private funds earlier, and maybe not many listening to this would remember, but there was something called the Long-Term Capital Management, LTCM, Long-Term Capital Management, that came asunder in 1998 as well. I was a little younger then, but I was serving in the Treasury Department, the U.S. Treasury Department at the time, and I remember it well. It was a private fund, a hedge fund that had failed, but the transparency the U.S. government had into it was scant at best, and it had over $1 trillion of derivatives, over $100 billion of assets, but only $4 billion of capital. Roughly, that's from memory. So I think the financial crisis came along and Congress reacted and said that for financial stability reasons, as Commissioner Peirce said earlier and others have, that it was important that the s.e.c. not only collect this information, but share it with other members of a newly formed council, Financial Stability Oversight Council. Those proposals, those mandates from Congress were put in place in 2011. And we're 10 years on, and I think we've learned a great deal since then. I support this proposal because if adopted, I think it would help federal regulators, this so-called Financial Stability Oversight Council, including the U.S. Department of Treasury, the Federal Reserve, the banking agencies, our sibling market regulator, the Commodity Futures Trading Commission, and ourselves, and the like, to better assess systemic risk. It also would bolster our Commission's oversight of private fund advisors and the protection of investors in those funds. The form that was adopted in 2011 sheds light on a lot, but there's a lot we've learned as well. It sheds light on a growing part of the financial sector that's not fully transparent to regulators. That's these private funds. Form PF provides the Commission and the s.e.c. with important confidential information with respect to basic operations and strategies of the private funds, and has helped establish a baseline for assessing systemic risk. But since the forms were put in place nearly 10 years ago, a lot has changed. In that time, the private fund industry has grown in size to a net asset value of $11 trillion and gross assets of $17 trillion. And it's also evolved in terms of business practices, complexity of fund structures, investment strategies, and exposures. And I do think that the Commission and the Financial Stability Oversight Council have had this decade of experience analyzing the information, collecting the information on these forms. And we have identified significant information gaps and situations where we would benefit from additional information. Now, when I was coming into office last April, it was very much on everybody's mind when I first met with the Secretary of the Treasury, when I first met with the Chair of the Federal Reserve. They wanted to highlight for me in my new job that we would benefit from more timely information in this space, particularly because of the fast-moving market events that had happened in March of 2020. And there were dysfunctions across various markets at that point in time. Thus, this proposal does the three things that Mike and Sarah and Jessica spoke about. First, the proposal would require certain advisors to hedge funds and private equity funds to provide current reporting of events that could be relevant to financial stability. Rather than waiting for the quarterly periodic reports of hedge funds or the annual periodic reports of private equities, if there was an event that's a financial stability related event, an extraordinary investment loss, significant margin and counterparty default events, there would be reporting. I do think that this is important for our fellow members of the s.e.c. and the s.e.c. but it's not just what I think. We had the team work with members across the s.e.c, particularly U.S. Department of Treasury and the Office of Financial Research over there, to see what are the gaps, how can we fill those gaps, what information would be helpful based upon 10 years or nearly 10 years of experience. Current reporting, back to long-term capital management, I can think of that if we'd only had that a little sooner than those events were occurring at that point in time, or in 2008, or during the 2020 early stage of this COVID pandemic. Second, the proposal would update the periodic reporting by large private equity advisors. And yes, as noted, it would bring us back to covering about 75% of the assets under management. I think that's a recalibration that is appropriate, but I look forward to hearing the public comments on that and seeing if they think that we've gotten this appropriately scaled. And third, the proposal would update reporting by large liquidity fund advisors to correspond with reporting the Commission had recently proposed for money market funds. I'm pleased to support today's proposal and, subject to Commission approval, look forward to the public's feedback. Looking ahead, I've asked staff to work jointly with the Commodity Futures Trading Commission to consider whether they would recommend jointly, the CFTC and s.e.c staff jointly would recommend amending some joint portions of Form PF. You see, though we're addressing a lot today, there are some joint portions of Form PF as well, primarily related to joint registrants with the CFTC. I'd like to thank our colleagues, particularly of all the s.e.c agencies and the Department of Treasury, the CFTC, the Federal Reserve, in particular, for their assistance. I'd also like to extend my gratitude to the members of the s.e.c staff working on this role. And now I'm going to just read off William Bird-Thistle and Jory Duty, Sarah Ten-Seekoff, Melissa Gaynor, Michael Noose, Samuel Thomas, Lawrence Pace, Alexis Pulashchek, Timothy Husson, John Hertzke, Roberta Ufford, Timothy Delaney, Michelle Beck, David Stevens, Kevin Treherne, Victoria Bacanova, Trevor Tatum, and all in the Division of Investment Management. Bear with me. From the Office of the General Counsel, Meredith Mitchell, Marie Louise Huth, Malou, Natalie Shioji, Monica Lilly, Kathy Ond, and then from the Division of Economic Risk and Analysis, we heard from Jessica, of course, but Ross Anshukazi, Alexander Schilla, Daniel Hiltjohn, Charles Woodworth, Marina Martinova, and then also the Division of Exams, which was helpful, Christopher Mulligan, Daniel Fagus, Division of Enforcement, Adam Adderton, Dabney Ariaton, and Daniel Pines, and Division of Trading and Markets, Michelle, Dan, and Ness. As you can see, we pull and we try to work across and collaboratively across this great agency. It's not just the operating units, Division of Economic Research, Office of General Counsel, but we try to pull in folks from our examination function, our enforcement function, other parts of the agency, where appropriate, to give advice and counsel on these proposals. With that, how do commissioners vote?
No.
Yes.
Yes.
Yes, the recommendation is approved by a vote of 3-1. I thank you all again. And with that, next up, we have the proposed amendments relating to the Treasury markets. These are reproposals around something called Regulation Alternative Trading System and Systems Compliance and Integrity. I'll turn it over to Hao Shang-Zhu, the Director of Trading and Markets, to present the recommendations.
Good morning, Chair Gensler and Commissioners. Today, the Division of Trading and Markets recommends updating the definition of exchange and Rule 3b-16 of the Exchange Act. This rule was adopted in 1998 to interpret the definition of the exchange. Since that time, this definition has not been amended despite the significant evolution in how market participants interact, discover prices, and agree to terms of a trade. For example, the current definition is predicated on the use of firm orders as opposed to non-firm trading interest. However, many trading systems today bring together buyers and sellers by using non-firm trading interest. This creates a disparity. Firm markets that perform similar functionalities are subject to different regulatory standards. Today's proposed rule would update the s.e.c. rule that defines terms in the definition of exchange in order to, among other changes, include systems that use non-firm trading interest. The division believes that bringing the benefit exchange regulation to these marketplaces and leveling the playing field will promote fair, orderly markets and enhance investor protection. The Division of Trading Markets is also recommending reproposing important changes that were previously proposed in September 2020. First, all alternative trading systems, or ATSs, that trade government securities should comply with the regulation ATS. Second, ATSs that trade sufficient volume in U.S. Treasury securities or agency securities should comply with the regulation s.e.c. Government securities play a critical role in financial markets and the economy. For example, U.S. Treasury interest rates are the fundamental benchmark for pricing virtually all financial assets. A significant fraction of trading activity in government securities occurs on systems currently operating as ATSs. For example, those in secondary markets for on-the-run U.S. Treasury securities. Many government securities ATSs are similar to systems that trade stocks in terms of the use of technology, the speed of trading, order types, algorithms, connectivity, data feeds, and the active participation of principal trading firms. Currently, however, certain government securities ATSs are exempt from the exchange registration and compliance with regulation ATS if they trade only government securities and register as broker-dealers, or if they are banks. The division is now recommending to promote operational transparency, investor protection, system integrity, fair and orderly markets, and regulatory oversight by applying regulation ATS and regulation s.e.c. to ATSs that trade government securities. I will now turn this over to Tyler Ramo of the Office of Market Supervision to discuss the proposed amendments in more detail. Thank you.
Thank you, Hao-Sean. Good morning, Chair Gensler and Commissioners. In the fall of 2020, the Commission issued a proposal to amend Regulation ATS and Regulation s.e.c. for ATSs that trade government securities. At the same time, the Commission issued a concept release on the regulation of fixed income electronic trading platforms, which, among other things, solicited comment on the scope of the definition of exchange under the federal securities laws. Commenters expressed broad support for the 2020 proposal, and the Commission received substantial comment on the concept release. Taking into consideration these comments, the Division is recommending that the Commission propose 3 sets of amendments. First, to amend s.e.c. rules regarding the definition of exchange. Second, to repropose with certain changes amendments to Regulation ATS and Regulation s.e.c. for ATSs that trade U.S. government securities. Third, to propose amendments to certain aspects of Regulation ATS that would be applicable to ATSs that trade security asset classes other than government securities, including the Fair Access Rule and Form ATS-N for NMS stock ATSs. First, the Division is recommending that the Commission propose amendments to Exchange Act Rule 3b-16 to include within the definition trading systems that offer the use of non-firm trading interests and provide protocols to bring together buyers and sellers. We refer to these systems in the proposal as communication protocol systems. They can include systems that use indications of interest, requests for quotes, conditional orders to bring together buyers and sellers of securities. Exchange Act Rule 3b-16 defines certain terms used in the statutory definition of exchange under Section 3A1 of the Exchange Act. Rule 3b-16 was adopted in 1998 and to more accurately describe the range of markets that performed exchange functions at that time. Trading systems then predominantly offered the use of firm orders and provided algorithms to match orders of buyers and sellers. At the same time, Rule 3b-16 was adopted. The Commission adopted Regulation ATS, which provided a regulatory framework for alternative trading systems. ATSs are systems that meet the criteria of Rule 3b-16, but are not required to register as an exchange if the ATS registers as a broker-dealer and complies with the conditions of the Regulation ATS exemption. Since 1998, electronic trading methods have evolved, and trading venues have increasingly offered trading interest other than orders and methods other than algorithms for buyers and sellers to agree upon terms of the trade. Like registered exchanges and ATSs, communication protocol systems perform a marketplace function for all types of securities. These systems bring together buyers and sellers who are seeking to access liquidity, discover prices, find a counterparty, and agree upon the terms of a trade. Unlike registered exchanges and ATSs, however, communication protocol systems are not subject to exchange regulation because they do not fall within the criteria of Rule 3b-16. As a result, market participants who use these systems cannot avail themselves of the same investor protection and fair and orderly market principles that apply to today's registered exchanges or ATSs. This regulatory gap also creates disparities that affect competitive balances among like marketplaces for securities. The recommended proposed amendments to Exchange Act Rule 3b-16 are designed to reflect today's security marketplaces and align the rule text more closely with the statutory definition of exchange. Under the recommended changes, Rule 3b-16 would continue to apply to systems that make available for trading any type of security. I would like to provide a brief overview of some of the recommended changes to Rule 3b-16. First, the division recommends including in Rule 3b-16 a definition of trading interest. Definition would include orders, as the term is currently defined under 3b-16, and non-firm indications of willingness to buy or sell a security that identifies at least the security in either quantity, buy-sell side direction, or price. Second, the division is proposing to amend 3b-16A2 to add communication protocols as an established method that an organization, association, or group of persons can provide to bring together buyers and sellers. Communication protocols, which can be applied to various technologies and connectivity, generally use non-firm trading interests and set parameters and structure for buyers and sellers to come together, negotiate, and agree upon terms of a trade. Other types of systems, though, would not fall within Rule 3b-16a. Under the proposal, current exclusions from the definition of exchange for order routers, single dealer systems, would remain. The division is recommending that the Commission propose to add an exclusion to the rule for systems that allow issuers to sell their own securities to investors. Consistent with the Commission's views expressed in Regulation ATS adopting release, when a broker-dealer exercises discretion and judgment over its customers' trading interests, such activity would still not qualify as exchange activity. Further, the division is not recommending to include within the definition of exchange a system that unilaterally displays trading interest without offering a trading facility or protocols to bring together buyers and sellers. In addition, a system that provides general connectivity for persons to communicate trading interests without protocols, such as a standalone chat function, would not be included in the exchange definition. We look forward to public comment on this proposal. The division is also recommending that the Commission repropose with certain revisions amendments to Reg ATS that trade government securities as defined under Section 3A42 of the Exchange Act, or repurchase and reverse repurchase agreements on government securities. These proposals would do several things. First, eliminate the exemption from compliance with Regulation ATS for ATSs that limit their securities activities to government securities or repos on government securities, and registers as a broker-dealer or as a bank. As a result, the provisions of Regulation ATS would apply to these ATSs. Second, the proposal would require a government securities ATS to file revised Form ATSN to disclose information about its manner of operations and the ATS-related activities of the broker-dealer operator and its affiliates. Notably, to limit the number of unique forms and simplify filing requirements, government security ATSs would file Form ATSN as revised, instead of previously proposed Form ATSG. Third, the proposal will provide a process for the s.e.c. to review disclosures on Form ATSN by government securities ATSs, and after notice and opportunity of hearing, declare the Form ATSN ineffective. This process would substantially be the same effectiveness process applicable to NMS stock ATSs today. Fourth, the proposal would apply the fair access rule to government securities ATSs that during at least 4 of the preceding 6 months had, with respect to U.S. Treasury securities, 3% or more average weekly dollar volume traded in the U.S., or with respect to agency securities, 5% or more average daily dollar volume traded in the U.S. Fifth, the proposal would extend the requirements of Regulation s.e.c. to government securities ATSs that, during at least 4 of the preceding 6 calendar months, had, with respect to U.S. Treasury securities or agency securities, 5% or more average weekly dollar volume traded in the U.S. Together, the proposals for government securities ATSs are designed to apply the investor protection, operational transparency, fair and orderly market, and system integrity principles of Regulation ATS and Regulation s.e.c. to government securities ATSs. The division is, finally I should say, the division is also recommending proposing other changes to Reg ATS for NMS stock ATSs and ATSs that are neither NMS stock ATSs nor government securities ATSs. These proposals would include revising Form ATSN by, among other things, including questions about communication protocol systems, the ATS's interaction with related markets, liquidity providers, and activities the ATS undertakes to surveil and monitor its markets. The proposal would require existing NMS stock ATSs file an amendment to their existing disclosures on Form ATSN. The proposal would also include adding a new type of amendment to Form ATSN to report changes to fee disclosures. The proposal would include permitting the s.e.c. to extend the review period for an initial Form ATSN and Form ATSN amendments if it finds that a longer period is appropriate. With respect to the fair access rule, the division is recommending that the Commission propose amendments that would do the following. First, provide minimum requirements for the reasonable written standards for granting, limiting, and denying access to ATS services that must be established and applied by all ATSs that are subject to the rule. These will require that, among other things, the ATS justify why each standard is fair and not unreasonably discriminatory. These minimum requirements do not alter the substantive requirement that the written standards be reasonable. Rather, to facilitate compliance, they explain in more granular detail what is required to be sufficient written standards. In addition, the proposed amendments would aggregate the trading volume of a security, category of securities for all ATSs that are operated by a common broker-dealer or affiliated broker-dealers for purposes of calculating the average transaction volume under the Fair Access Rule. This proposal is designed to help further the vital policy goal of ensuring that no single entity is able to restrict fair access to a security or type of security. Finally, the Commission is recommending that the Commission propose to amend Reg ATS to modernize Form ATS and Form ATSR and require that both forms be filed electronically. I'd like to turn it over to Jessica Wachner for the Division of Economic and Risk Analysis for a discussion of the economic effects of the proposed amendments. Thank you.
Thank you, Tyler. Good morning, Chair Gensler and Commissioners. As my colleagues from Trading and Markets have described, alternative trading systems have existed since the 1990s under a regulatory framework that allows platforms to operate as exchanges subject to more limited oversight than registered exchanges. At present, however, some important platforms are neither regulated as registered exchanges, nor do they comply with Regulation ATS. This rule addresses two types of these. The first are those acknowledged to be alternative trading systems, but are exempt under current rules because they trade only government securities. Removing the exemption for ATSs that trade government securities as proposed would bring greater investor protection and resiliency to a market that is at the core of our financial system. Treasuries are the benchmark against which many assets are priced. Regulations such as fair access and systems compliance and integrity are as important for these platforms as they are for platforms trading in other asset classes. So I mentioned two categories. The second category consists of platforms that do not fall within the Commission's criteria to be an exchange and are neither registered exchanges nor ATSs. Under the SEC's current rules, an exchange, among other things, offers the use of firm commitments to buy or sell. However, a significant portion of electronic and trading in treasuries, as much as 40%, takes place on platforms that do not have firm trading interests, but nonetheless bring together buyers and sellers according to a stated protocol, which is the economic function of an exchange. An important principle is that platforms that perform similar economic functions should be regulated similarly. Communication protocol systems under the proposal would fall within the definition of an exchange and, given the choice to register either as an exchange or operate as an ATS. The regulations for registered exchanges and ATSs bring greater protection for investors and enhance resiliency, but if a category of platforms is missing these features, that will harm the market as a whole. Moreover, while all benefit from the safety of the regulations, if only some pay the costs, those paying the costs are at a competitive disadvantage. By subjecting both current ATSs, for example, and non-ATS platforms to similar regulation, the benefits of alternative trading system regulation will be more likely to be realized in greater resiliency and price discovery across the market. So these rules may increase costs for some platforms. Some of these platforms are currently not broker-dealers, which is a prior step before becoming an alternative trading system. So the proposal would require them to become broker-dealers. They would be required to file forms, and if they operate at size, to comply with fair access and regulation s.e.c. These steps involve compliance costs, but entities serving similar functions bear these costs already. We expect that these rules will bring greater efficiency to the trading of government securities and to other securities, with the potential to lead to greater capital formation. In closing, I want to thank my colleagues in the Division of Trading and Markets in the Office of the General Counsel, with whom we have worked closely during the development of these proposed rules. Thank you, and we are happy to answer questions.
Thank you so much, Hao Shang, Tyler, and Jessica, for your presentations. I turn it to Commissioner Peirce.
Thanks, Mr. Chair, and thanks to Shang, Jessica, and Tyler. Events in the U.S. Treasury market, as well as the related repo market over the past several years, strongly suggest that the market for government securities suffers from inadequate levels of intermediation, liquidity, and transparency that in times of stress can dramatically decrease its ability to function properly and significantly increase risks to market participants. Commentators have suggested a number of possible reforms, and although I'm skeptical of some of these suggestions, I agree that the Commission should be considering carefully how it might use its authority to make changes that could relieve some of these pressures and help ensure that the market continues to perform its vital functions in the U.S. and global economy. Careful consideration of fundamental issues of market structure is particularly important in the government securities market. It performs a central role in fiscal and monetary policy, as well as in our financial markets more broadly. The market is enormous, with over $22 trillion in U.S. Treasuries outstanding as of December 2021, and with over $600 billion in average daily trading volume during the last calendar year. Any efforts to reform this market must take into account the potentially cataclysmic risks of inadvertently masking and making things worse through sloppy or rushed rulemaking that introduces uncertainty for market participants or that deprives the public and the Commission of the opportunity to devote careful attention to thinking through the full implications of the proposed rules. The proposal we're considering today is certainly not sloppy, but at the same time, it's too wide-ranging and, given its length, too unwieldy to facilitate careful consideration. The document weighs in at a hefty 650 pages, contains over 220 separate requests for comment, with many requests containing multiple questions, and addresses about a dozen significant issues, several of which affect trading venues of all types, including currently unregulated communication protocol systems. And the release goes well beyond government securities or even fixed income securities. Key parts of the proposal affect trading venues that make any type of security available for trading. Notwithstanding the literal and figurative bulk of this release, the Commission has determined that it's appropriate to provide the public with 30 days to read, understand, consider, consult, identify, model, assess, and discuss these rules and how they are likely to affect trading venues for every type of security that is traded in our markets. It would have been an irresponsible abdication of our role as the primary overseer of the U.S. capital markets to limit the public to a 30-day comment period on fundamental changes to the $22 trillion Treasury market. It's unconscionably reckless to do so for a proposal that the effects of which will reverberate through all the markets that we regulate in ways that we cannot foresee. I can't comprehend why we insist on blindfolding ourselves rather than embracing the notice and comment process that has been so valuable in unearthing issues for our consideration. Our self-imposed unrealistic time constraint will prevent us from thinking seriously about the possible effects, intended and otherwise, of our rules by refusing to give the public sufficient time to provide us with informed comment. We face no emergency in these markets that compels us to limit comments to 30 days. Indeed, the Commission's precipitous rush to plow through the comment period, almost as if it were a mere formality in our process, presents a greater immediate risk to the market than any of the issues that have led to this recommendation. I could have voted for this proposal had the Commission provided a period long enough to enable market participants and others to engage in a considered analysis of the proposed rules and their likely consequences. 90 days would have been a reasonable period, given the breadth of issues and the potential effects of the proposed rule. Any shorter period would not be sufficient to give me the confidence that the Commission was receiving sufficient public analysis and comment to enable us to proceed to adoption in a manner consistent with our responsibilities to the market, to the law, or to the American people. I regret this outcome. Much of today's proposal in its broad outline seems reasonable. Staff has spent a lot of time thinking about how we might make incremental changes to the government securities market, and it shows. The proposed rules would bring venues that facilitate the trading of government securities and repos within our regulatory ambit, effectively forcing venues that make these securities available for trading to become ATSs. These ATSs would need to file an amended version of Form ATSN, which would help market participants better understand where and how they can trade these securities. The rules would also subject the larger ATSs to the Fair Access Rule, which could ensure access to liquidity for a larger proportion of market participants. Because more venues would be operating as ATSs, trades executed on these venues would be reported to TRACE, which should increase transparency in the market. Although I don't agree with every policy line that the proposal draws or every deadline that it sets, I could have supported this proposal if it allowed for careful consideration and informed comment that would have helped me evaluate whether the changes staff is recommending would work in the real world. The staff is also recommending an amendment to the definition of exchange in Exchange Act Rule 3B16. Unexpectedly for me, and perhaps for many in the market, this proposed amendment goes far beyond the scope of the concept release that was issued with the initial September 2020 proposal. What the staff is recommending for our consideration today is an expansion in the definition of exchange that would apply to any trading venue, including so-called communication protocol systems, for any type of security, not just for government or fixed income securities. This change could deter innovation and dissuade new entrants from entering into the market for trading venues and execution services. But communication protocol services have become more sophisticated and now play a significant role in the trading of certain types of securities. I could so that allowed for careful consideration comment on how this changed competition in this space. The staff is also recommending a wholesale revision to Form ATSN that will require all NMS stock ATSs with currently effective forms to file amendments to the Commission. This part of the proposal would likely impose significant burdens and could lead to a replay of some of the difficulties that ATSs and our staff encountered when we adopted Form ATSN just a few years ago. Many of these changes flow from the proposed amendments to the definition of exchange and thus are understandable, but it's unclear whether it's reasonable to expect these ATSs to repeat this process so soon after expending considerable resources on filing these forms in the very recent past. Nevertheless, I could have supported a proposal that allowed for careful consideration and informed comment on how these revisions would affect these venues. A final message to those who operate any service that is designed to facilitate any communication between potential buyers and sellers of any type of security. Read this release. Even if you have nothing to do with government securities or even fixed income or with traditional securities, read this release, preferably as soon as it's published on the Commission's website. It covers a lot of ground, and you should not assume that it has nothing to do with you, because it probably does. In closing, I would like to thank the staff in TM and DERA for the time, a lot of it they spent on the phone with my counsel and with me, walking me through the many issues covered in this release and answering my many questions. And a special shout out to Tyler Ramo, who exhibited in our conversations his characteristic great patience and inexplicable good cheer. I appreciate the team's hard work on this document and know that you will engage with the public proactively to make the most of this exceedingly short comment period. I don't have any questions.
Commissioner Peirce, I thank you. Before I turn to Commissioner Lee, I just want to also say we try to put these documents on the public website depending upon vote, but if we were to vote on this, it would go on the website. It often doesn't end up in the Federal Register for weeks. In fact, our last commission meeting on December 15th, where we voted out 4 items, they're not yet in the Federal Register. So as a practical matter, we're told by the Federal Register right now they're running 6 to 8 weeks behind. That's not always the case, but given that process, that our 30-day clock on something like this starts once it gets in the Federal Register. But what we do is we put these documents on our website. So as Commissioner Peirce said, I would encourage everybody to read it, not just if you're in the government securities field, because absolutely there's some changes here that could affect other markets. These important changes to the definition in the rule text of exchange. Look on our website in the next couple days, start to weigh in, start to read it, start to assess it. It might be in the Federal Register before 6 to 8 weeks, but it's going to be a time before it's in the Federal Register before that 30-day clock even starts. So I think frankly, we're probably closer to the 60 to 90 days that Commissioner Peirce mentioned 90 days, but
well, although
in reality as to what's happening with the Federal Register, and it's just a pragmatic reality that it's a lot longer than 30 days.
I would say though that we've long put our releases up on the website as soon as we vote to adopt them, and so that's not new. And the fact that there's a delay before the Federal Register is also not new. Yet for a proposal like this, we would in the past have had a much longer comment period. And I understand that there's a real interest in moving things forward, but it serves everyone better if for planning purposes they can know that they're going to have 90 days from the publication date in the Federal Register to put together thoughtful comments, to really think through the many pages of this release and the many questions. And it would serve us all better if we could really provide that certainty ahead of time that there's going to be a nice long period to think about these things.
Well, we do look forward to the thoughtful comments and recognizing the pragmatic effect of where the Federal Register is. It will be longer than that probably either of us anticipate right now. But Commissioner Lee.
Thank you. U.S. government securities play a central role, not just in the U.S. economy, but in the global economy as well. And the Treasury market alone is a critical component of U.S. and global financial systems, with, as Commissioner Peirce noted earlier, roughly $23 trillion in outstanding securities at the end of 2021 and around $577 billion in average daily trading volume at the same point. These platforms on which these and other government securities trade thus also play a significant role in the smooth functioning of U.S. and global financial markets. And today's proposal seeks to bring greater transparency, greater fairness and greater resilience to these platforms in two ways. First, by modernizing the definition of an exchange to include certain communication systems that have come to provide the same functions performed by exchanges, but do not have the same investor protections or regulatory oversight to promote fair and orderly markets. Government securities trade on these systems and platforms where buyers and sellers can communicate, negotiate, and agree to trading terms using requests for quotes systems, conditional order systems, and systems that electronically display continuous trading interest. These platforms have similar business models and engage in similar market activities to exchanges, but are not subject to the same regulatory framework. And this disparity in treatment creates competitive imbalances that today's proposal seeks to address. Second, today's release reproposes with certain revisions the Commission's September 2020 proposal to eliminate the exemption under Reg ATS for ATSs that transact solely in government securities. These ATSs play an important role in government securities markets, for example, accounting for approximately a third of Treasury securities trading volume in the first half of 2021. Under today's proposal, these platforms would be required to file Form ATSN and become subject to Commission review and ineffectiveness procedures, disclose information about their operation, and for platforms that meet certain volume thresholds in Treasury or agency securities, comply with the Fair Access Rule, and implement the operational protections provided by Regulation Systems Compliance and Integrity, or Reg SCI. I look forward to reviewing the comments on both aspects of this proposal, and I'm also hopeful that commenters will weigh in on potential additional changes or requirements to the ATS framework that may be needed. For example, should the requirements currently applicable to NMS stock ATSs, and now as proposed to government securities ATSs, be applied to ATSs that trade other security asset classes, including filing public form ATSN and being subject to the Commission review and effectiveness process. So with that, I'll thank the staff in Trading and Markets, in the Division of Economic and Risk Analysis, and in the General Counsel's Office for their thoughtful work. And I want to thank the Chair for your leadership on this proposal, which I'm pleased to support. Thank you.
Thank you, Commissioner Lee. Commissioner Crenshaw.
Thank you, Chair Gensler, and thank you to my fellow commissioners for your thoughtful remarks. I also want to join my colleagues in thanking the staff of the Division of Trading and Markets, the Division of Economic and Risk Analysis, and the Office of the General Counsel for your hard work that went into this release. And I also want to briefly thank S.e.c. and the Chair's Office and the other councils for their assistance in getting this proposal to this open meeting today. When Congress amended the Exchange Act in 1975, it found it to be in the public interest to assure, quote, fair competition among exchange markets and between exchange markets and markets other than exchange markets, close quote. The Commission quoted that language when it adopted Regulation ATS in 1998, more than 20 years ago, and has reiterated the principle in subsequent releases relating to alternative trading systems, or ATSs. Assuring fair competition has been and continues to be an important objective for the SEC's regulation of exchanges and ATSs. The amendments we're proposing today would advance that objective in two important ways. First, fair competition requires entities performing similar functions to be regulated similarly. However, under our current framework, there's a disparity among similar markets. Specifically, entities that offer the use of protocols and non-firm trading interest to bring together buyers and sellers of securities are not currently subject to our exchange regulatory framework, despite performing similar functions to ATSs and registered exchanges. These trading venues have become increasingly popular for fixed income and government securities, and the U.S. Treasury market in particular account for approximately 50% of total electronic trading volume on multilateral trading venues. This has both competitive effects and negative implications for investor protection, as these systems are not subject to SEC oversight or the SEC's requirements related to transparency or fair and orderly markets. I'm pleased that today we are proposing to address this disparity by bringing these communication protocol systems under our exchange regulatory framework. We are proposing to do this by updating the definition of exchange to include systems that offer the use of non-firm trading interest and communication protocols to bring together buyers and sellers of securities. This should help ensure that there's a level playing field for entities performing similar functions, as well as providing important investor protections, including requiring these entities to establish written safeguards and procedures to protect confidential subscriber trading information, meet the operational transparency requirements of Form ATSN for entities that trade national market system stocks or government securities or repos, and comply with fair and orderly market provisions under the Fair Access Rule. Furthermore, as far back as 1998, the Commission was concerned that system providers might label trading interest that is firm in practice as non-firm, in order to avoid registering as an exchange or complying with Regulation ATS. This amendment would remove that potential loophole and ensure that the distinction between firm orders and non-firm trading interest is not used to evade our rules. I look forward to hearing from commenters on the scope of these amendments and whether or not they may be over or under inclusive. However, as our former colleague, Commissioner Roisman, put it, the failure to regulate these significant intermediaries is, quote, obviously a gap, quote, that I am pleased today we are taking steps to close. Turning to the second way in which this proposal helps advance the objective of fair competition, competition among venues requires customers to have the ability to evaluate and compare them in order to determine which best meets their needs. However, ATSs trading government securities are not currently subject to the operational transparency rules that apply to ATSs that trade NMS stocks, including the obligation to file public disclosures. In addition, ATSs that trade government securities are exempt from the Fair Access Rule and the requirements of Regulation s.e.c, and ATSs that trade only government securities are exempt from the requirements of Regulation ATS altogether. As Commissioner Lee noted, it's hard to overstate the importance of the government securities markets and the U.S. Treasury market in particular to the U.S. and global economies. Recent disruptions, such as the flash rally of October 2014, the sudden spike in repo rates in September 2019, and the COVID-related market disruption in March 2020, triggered extensive interventions by the Federal Reserve and are a reminder of how critical these markets are to the financial system. And ATSs and communication protocol systems together represent over half of the trading activity in those markets. The proposed extension of Regulation s.e.c and the Fair Access Rule to those venues is an important and overdue step that should enhance market stability, resiliency, and integrity. Additionally, and critically, we are proposing to extend certain operational transparency requirements to ATSs that trade government securities. If adopted, these amendments will provide more transparency to market participants about the operations of these ATSs, including how trading interests are handled, fee structures, the ATS's interaction with related markets, liquidity providers, activities the ATSs undertakes to surveil and monitor its markets, and any potential conflicts of interest that might arise from the activities of the broker-dealer operator or its affiliates. This should enhance competition among these ATSs by allowing investors to compare different venues using standardized, publicly available information, and to choose the one that best suits their trading objectives. Additionally, it would help shrink the disparity between the regulation of ATSs and exchanges by requiring a greater share of ATSs to make public disclosures related to their operations, which would be subject to the Commission's review and effectiveness process. Finally, I want to highlight that in this release, we're soliciting comment on other ways to improve the ATS framework. For example, we're soliciting comment on the possibility of extending the operational transparency requirements of Rule 304 to all categories of ATSs, including ATSs that trade corporate debt securities, municipal securities, and equity securities other than NMS stocks. Many of the same concerns that motivate the proposal to extend transparency requirements to government securities ATSs are present in these other markets, which also have become increasingly electronic. Extending these transparency requirements to all ATSs and making them subject to the Commission's review and effectiveness process may present another opportunity to advance the objective of fair competition, as well as the protection of investors and market resiliency and stability. We are also soliciting comment on whether to prohibit certain practices that present potential conflicts of interest, including the disclosure of confidential subscriber information and trading by the broker-dealer operator and its affiliates in the ATS. I look forward to hearing commenters' views on these issues, other potential reforms to the ATS regular structure, and all aspects of the proposal. Thank you again to the staff for your hard work, and I'm pleased to support the proposal.
Thank you, Commissioner Crenshaw. Thank you all, my fellow commissioners. Today, the Commission is considering amendments to include significant Treasury market platforms with regulation, as you've heard, alternative trading system, ATS. I support these amendments because if adopted, they would help promote resiliency and greater access in the Treasury market. We're also considering proposals, as we've discussed, around the regulations as to what is an exchange. Congress enacted, as has been noted, in 1975. We've had a lot of changes throughout these decades since then about the use of electronic platforms, and I also think it's appropriate that we revise the rules with regard to the definition of exchange, as Director Jessica Wachter mentioned earlier in her economic analysis as well. In 2020, the Commission put out a request for comment on a proposal to enhance transparency and oversight on these Treasury platforms, alternative trading systems that trade in government securities. Today's release includes the core elements of that 2020 proposal, including registration of certain interdealer brokers, so-called IDBs, in the Treasury markets. It would bring the Treasury trading platforms with significant volume under another regulation, systems compliance and integrity, which is important in terms of the critical infrastructure of our markets and the resiliency of our markets against disruptions, including cyber events. It also would require these platforms to comply with what others have said, fair access, or the fair access rule, which provides for fair access for platforms, would prohibit platforms from making unfair denials or limitations of access. Beyond that, though, today's amendments builds on the 2020 proposals and feedback from the public, as Tyler had gone through. We heard much from the public on a request for comment about the secondary markets of treasuries is now facilitated not just on these so-called IDBs, but as well on request for quote platforms. And as Director Wachter said, nearly 40% of the volume is on those platforms as well, between dealers and customers. Several commenters requested we consider bringing both the request for quote platforms along with the so-called interdealer broker platforms into the proposal. Additionally, that all alternative trading systems subject to the fair access rule would need to have reasonable written standards for granting, limiting, and denying access of services. So relatedly, I do support the element of this proposal that modernizes the rules related to the definition of an exchange to cover platforms for all kinds of asset classes that bring together buyers and sellers. As others have noted, our U.S. Treasury market, now nearly $23 trillion in size and growing, is the important base of our entire capital markets, particularly the rest of the fixed income markets. And so I think with these proposals today to bring greater resiliency and yes, regulation to the key platforms in this space is an important initiative that will promote transparency and competition as well as resiliency in this important market that's so relevant to every American because we're the issuer ultimately. We are the issuers as taxpayers of U.S. Treasury debt. Together, I believe that these steps would promote resiliency, greater access in the Treasury market, which, as I said, forms this incredible base to our capital markets. I'm pleased to support the proposal and subject to Commission approval. Look forward to the public's feedback. As we talked earlier, please look on our website. Right now, the Federal Reserve Federal Register is running literally about 6 to 8 weeks behind. So please do look at our website near term. We look forward to your comments. I want to now just turn and appreciate not only my fellow commissioners' time and collaboration on the proposal, in particular, again, former Commissioner Roisman, who was working on this all the way up until the middle of last week and helping with advice and counsel on some of this, had really spearheaded many of these efforts for many years. I'd also like to thank the staffs of our fellow regulatory agencies who consulted on these issues, but particularly the Department of Treasury and the Board of Governors of the Federal Reserve and the Federal Reserve Bank of New York, the Federal Reserve Bank of Chicago, and the Commodity Futures Trading Commission, all of whom we reached out and got good thoughts and counsel. My gratitude to the members of the s.e.c. staff who worked on the rule, including, here we go, from the Division of Trading and Markets, Hashang Zhu, David Saltiel, Tyler Ramo, Ronnie Bergefin, Meredith McVicar, Josh Nemo, David Showman, Heidi Pilpal, Megan Mitchell, Matthew Curcio, David Garcia, Joanne Kim, David Liu, Sarah Gillis, Hawkins, Joanne Rutnochsky, Shauna Shapin, Shauna Sappington, Tom Eady, Steve Gibson, James Blackmore, Jeff Mooney, Ujay Sataria, Elizabeth Fitzgerald, Catherine Lesker, Umair Katz, Patrick Norton, and An Pan, all again from Trading and Markets. Then from the Division of Economic Risk Analysis, of course, Jessica, who presented, Oliver Richard, Lauren Moore, Amy Edwards, Songwan Wu, Paul Barton, John Ritter, Julia Reynolds, Chantel Hernandez, Michael Watts, Mike Willis, PJ Hamidi, Tashani Ya, and Verutio Sin. Then from the Division of the Office of General Counsel, Dan Berkovitz, Meredith Mitchell, Malou Huth, Robert Tepley, Sean Bennett, Donna Chambers, and then from the Edgar Business Office, Jane Patterson. How do commissioners vote on the division's recommendation to issue proposed amendments regarding both the definition of exchange and the regulation, alternative trading system, and systems compliance and integrity?
No.
Yes.
Yes.
Yes, the ayes having it 3-1. If we can send that to the Federal Register. That concludes the business on today's agenda. With that, the meeting is adjourned.